The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, on Wednesday, we saw mostly two-sided to lower trade in grains and in livestock. That soy complex tried to stay green. It started there early, but just kind of faltered off the highs and ended mixed as we got through the day on Wednesday. Livestock, cattle futures as well, pulling back a little bit. Maybe we're waiting for cash trade this week. It's something that we have to take note of here and talk about. Plus, the Federal Reserve has wrapped up their two-day policy meeting. Let's talk about all of it. Joining us for a conversation, he is with Global Commodity Analytics. Mike Zuzolo is with us here today. And Mike, good to catch up with you again this week. Let's start with the Federal Reserve. As expected, no interest rate change. I know we're getting some of the comments out from Fed Chair Powell as we are talking right now. It seems like everything's kind of status quo when it comes to the Fed, Mike.
Yeah, their comments before the press conference was we've got elevated inflation, but we also got a very good job market, low unemployment, and we've also got the high frequency data still showing a very robust economy, and they don't see the need to do anything at this point. That makes sense right now, Jesse, from my standpoint, because we are in the middle of these big trade negotiations and a lot could change. Hopefully by the time we get to this weekend, but even 30 days from now, the Federal Reserve can reevaluate it. I would say, though, if we don't get trade deals signed and the tax cut bill is not looking good in 30 days as far as getting passed by July 4th and getting moved pretty quickly in the early part of summer, I hope the Fed does listen and take President Trump's recommendation to start getting ready to cut maybe as soon as by September so that they can get ahead of a weakening economy. As we talked about last week, a lot of people blew off the GDP data, but I would say there's other data out there that's suggesting that we are going to slow down if we don't get some of these trade deals signed, and the Federal Reserve is going to have to play a big role in keeping our economy aloft and our commodity demand and our merchandise trade demand, still very strong through the rest of the year.
Well, you shared some interesting charts with me to help us kind of tie in with the Fed news here today. And let's start with a look at some of the intermodal traffic and walk us through what your thinking is here and how this could tie in with the Fed and tariffs and trade and the overall economy picture right now.
Well, the weekly data from the American Association of American Railroads has always been very important. Unfortunately, now they're charging for subscriptions for their full report, but they do offer still some of these key charts that you can look at on their website. And I still think this is a very good piece of high frequency data, especially when we talk about real economic manufacturing, not services type data. And the intermodal traffic is essentially your container traffic moving across country by rail. And you notice that we, until week 10, looked very simple, very easily along the same lines as last year in terms of seasonality. And we're even actually outperforming last year's levels in net containers and carloads being shipped out. By the time we got to week 15, though, we noticed that instead of putting a bottom in the intermodal traffic and going up into essentially all the way through the rest of the year with a little bit of a hiccup in the late week 20, early week 30 time period, the market is this time around looks like it's starting to go down. This matches up with the Port of Los Angeles saying that their container ships traffic is going to be down about 35% this week. That's going to be the new norm if we don't get a trade deal with some of these big countries, i.e. China or India. And that's the big thing to watch, I think, by the end of the week of this week as we prepare for the WASDE report next week. We're probably not going to get anything from China because we don't meet with them until Saturday. Going to be hard to get a trade deal before the WASDE report on the 12th as a result of that. But if we could get a trade deal with India announced before the WASDE report, that would mean a lot to me because this intermodal traffic is suggesting we are slowing down. We are going to lose some of our key imports. That also means, too, Jesse, that all these goods that we've been used to getting to fill our shelves, if we start to cross through that light blue line as we get into week 20 and we go counter seasonal and drop below last year's levels, that suggests we've got tighter supplies, and that would mean more inflationary pressures. And that then would keep the Federal Reserve from wanting to cut rates. And so it gets into a really tough dynamic for the Fed, and it's something we really want to keep an eye on.
What about the grain traffic specifically here when it comes to railroad traffic? Another chart from the Association of American Railroads. What stands out to you when you look specifically on the grain traffic?
Well, this is the exact opposite. And this is what's so puzzling to the corn market breaking so hard today, which we could talk about here in a minute. But look at the seasonality in this chart, and we see that the grain originated traffic here is going up counter seasonally higher at this stage. Was that due to extra buying? Maybe some, but we still continue to see South Korea buy from the United States and other countries this week pretty heavily. Our export inspections this week, 1.6 million metric tons, matching last week's numbers for corn. I think most of this is corn. It's not wheat. That's, I think, almost guaranteed. But you're talking about a situation where most of this is going to be corn or sorghum or something like that, and we're going counter seasonally higher. And so I guess to blend these two charts together, as I look at this market this week, it's not surprising to me to see the market sentiment on Wall Street and in the currency markets and in the grain trade and now the livestock trade start to say, hey, we're tired of hearing about all these trade deals coming. We want some actual trade deals signed, sealed, and delivered at this point. And the talk is not enough. And we've seen that with the resumption of the weaker dollar, the stronger gold, the weaker Wall Street price action. And now we're starting to see the grains and the livestock give way as well. And I think that directly goes back to something you reported on your website earlier today, and that was the fact that Japan did not get the okay by the United States for reciprocal tariffs and to have everything just cut back down to zero. South Korea is also asking the United States to see if we couldn't wait till June when they have elections for their president before we sign a trade deal with them, it looks like, and that's coming from the Asian news sources that I have. So I think the trade's tired, and it makes sense why the market would start to go down. But when it comes to the corn being the leader to the downside, that's what doesn't make sense when it comes to this chart, when it comes to the Western Corn Belt drought, and when it comes to what I'm hearing now in parts of Indiana and Illinois, Southern Illinois, especially a real slowdown in the planting progress.
Let's talk weather here real quick. And you bring up a couple key points. We have concerns about drought in the west and a lot of rain in the east. And let's start with the latest GFS model. And I mean, you look at this, a lot of rain for the southeast here, particularly, but not much in the middle part of the country. A fairly wide open planting window for much of the central and western Corn Belt right now.
Yeah, you're getting a little bit up in the northern and west parts of this map and this model run from the GFS on noon Wednesday, but you're starting to see a high take shape and that dome take shape. As you say, the big rains in the southeast, big rains in the northwest, but in the center of the country, not much to be seen. This is a pattern that we're going to have to watch very carefully because 30 days from now, if we keep this pattern up, we're going to have several major states, including parts of Minnesota and Iowa, but the Dakotas, Nebraska, and even parts of the northern half of Kansas looking at some really tough situation and conditions.
Well, and let's look at that drought intensity map, and this kind of illustrates it. I know Nebraska really is feeling the effects here right now. I've been seeing some folks with pastures, ranch land that are worried about that aspect here. You look up into western North Dakota as well, into Montana. I mean, just watching this drought intensity right now and concern here, rightfully so, if this pattern holds, we're going to be needing moisture pretty quickly.
Yeah, you're right, Jesse. And we've got some emergencies declared by the USDA already this early in the year for parts of South Dakota and some counties bordering in Nebraska and Wyoming as well. This is very early to be getting declarations of drought and emergency by the federal government. And this is the current drought intensity map a week ahead, which is what this program I purchased allows me to do. A week ahead from now, that central part of Nebraska all the way over into the northern half of Illinois, that actually intensifies while the drought up in the top left part of your map, the Montana area, actually does get some rain. So that matches up really nicely with that 7-day precip forecast from the GFS, two completely separate programs. That's kind of how I double check the weather in my office instead of relying too heavily upon private forecasters.
We're having a conversation today with Mike Zuzolo from Global Commodity Analytics here on Market Talk. Let's talk specifically about this corn trade, Mike, and look at the July D spread. And I've noticed that's really felt like it's been breaking down here over the last several sessions. And we saw old crop under pressure here more so than the new crop on Wednesday. But this corn market in general just feels like it's kind of on the struggle bus, I guess, for lack of a better term right now, Mike.
It is, and that July D's corn spread we're looking at right now, getting down to the March lows, which were also, as you can see by this chart, at the 2025 lows. We closed around 9 cents on Wednesday. This chart was done when it was around 8.5 cents, but that 8-cent low from the 1st of March is the 2025 low. It's representing very well the critical nature of the weekly corn chart right now, and how we're eating into a major trend line support on that weekly corn chart on a lead month basis, with May still the lead month futures. So both these charts, one being May and one being the July D's corn spread here, suggesting we've got some real technical issues to have to contend with if we close this week out below these critical support lines. And this is where it goes back to what doesn't really make sense to me, given the fact that we do have such a critical situation on the domestic front with tight old crop stocks, and we have an extremely tight world stocks. I can say also, Jesse, the wheat market is part of the reason I think this spread has broken down, along with Chicago colleagues I've talked to this week saying that they think South America is a done deal. Big corn crop, big bean crop coming. This spread was about a month and a half ago, and maybe even all the way back towards the beginning of 2025, our South American drought spread. It's our indicator for the South American drought and the nervousness of the futures market. I'm going to redub this as our North American drought spread at this stage of the game. So if the December stays discount to the July and the July jumps against the December, I think we've got some weather to be playing out here.
Yeah, hearing some of those same comments as well about South America, how it seems like it's a done deal with that crop for the time being anyway. We could always see a shift, but it's seeming like that is the case. Let's talk the November soybean, December corn spread as we look at that chart. And, we've started to kind of get into that roll period, so to speak, and it's felt like a lot of folks are starting to put more emphasis on the new crop versus the old crop. So as we dive into this spread, what are you tracking right now, Mike?
Yeah, and this makes sense too. Why you would compress the old crop, new crop spreads is because you're thinking the demand is no longer as important as the new crop supplies. And I think that goes back into the trade deal issues. This spread, the November beans, you see, have gone essentially sideways since we had that big break to the downside in the early part of April. Found a low, and this is the purple chart, the November beans. We made the high with the corn pulling the beans up in mid-April. Then we've pretty much gone sideways in November beans while the corn has fallen. This is your spread trade. This is your funds, I think, unwinding long corn, short bean positions. And this kind of matches up with what the new crop numbers look like. I was surprised. A lot of the trade guesses out there are putting us back at a 2 billion bushel corn carryover for new crop 25-26. The numbers we get next week from USDA. Beans, they're around 370 for an average on one of the key news wires. So when you look at it from that standpoint, it doesn't look nearly as burdensome on beans versus the corn. I'm in just the opposite camp. I think the demand side, the export demand, especially for the soybeans, is going to be a lot tougher. The airlines are talking about a lot less travel this summer and lowering guidance. That's your sustainable aviation fuel. So I'm a big contrarian right now with feeling like the tight old crop corn will translate into tight old new crop corn as well. And same with the beans. Big old crop stocks remain relatively surplus, especially given what USDA could do to our Chinese exports and what they buy from us in 25-26, because we will get those new numbers.
A lot of things to keep an eye on, especially on the soy side too. Thinking about some of those biodiesel numbers that we've been waiting on. Sounds like reports are maybe in the next 2 weeks. So that would be pretty consistent with that Memorial Day timeline that we've been hearing about. But we'll see how something like that impacts the soy complex. I want to use this is a segue to talk livestock a bit. Let's look at that pork and bean trade. I love when we do this. Looking at the correlation between soybeans and lean hogs right now, and this hog market, Mike, has been one that just has felt like it hasn't had much of a technical footing here as of late. What are you tracking here between the correlation of soybeans and hogs right now?
Yeah, lead month hogs had their run earlier and now have kind of flattened out. And this makes sense that they are going to be joining up more with the soybeans because of the U.S.-China trade relationship. This is one of those other key leading indicators as far as what the grain trade and the meat trade and Wall Street are looking at when it comes to trade deals, Jesse. I think the Japan deal being put off and the South Korean deal being put off, I think that may have hurt the livestock markets this week more than we understand. The other thing about this spread is we are getting very close with the summer grilling seasonal. Tyson earnings came out. They showed a big drop in volume sales for beef, not as big a drop in volume sales for pork. That was because their price of beef went up 8% plus versus the second quarter of last year compared to this current second quarter just finished. And while the pork price only went up about 4%. So beef is outpacing the pork price at the meat counter, and that's going to continue. And this makes the BLT seasonal, when the tomatoes come on and the bacon, lettuce, tomatoes seasonal come on in July, that much more important. But for now, this is about the China-U.S. trade relationship to me in terms of what these markets do together between beans and hogs.
All right, let's round it out with cattle trade. A bit lower in futures on Wednesday. I know we're really keeping an eye on what that cash activity is going to look like this week. We did see some early week business in the South, kind of around that 220 mark, but still waiting for more trade, still waiting for action in the North. We've been setting records again, and then you kind of pull back here a little bit at midweek. When you look at say live cattle versus packer margins right now and kind of analyze it from this perspective, what stands out to you, Mike?
You know, a lot of people would probably say, why do you look at this right now when we know supplies are tight in cattle and getting tighter? And Tyson agreed with my earlier analysis that you and I talked about, that retention is probably starting in the cattle herd at this point. I think it really started properly after the inauguration of President Trump because of the green gas issues that ranchers were wondering about before the election. But the reason I look at this chart, Jesse, is because we do have ample on-feed supplies right now. There is no problem with meeting market demand right now, given the price levels we're at, and given the fact that while grocery store demand seems to be very robust, but that's at the expense of people not going out to eat as much, your margins are getting compressed when it comes to the retail side. And so packers still have a great deal of control over this market until we finally start to tighten the on-feed supply numbers, probably later this summer. I would guess July, August is when we'll really start to see that show up. But this packer margin situation, I think, is real. The ratio between live cattle and packer margins is what the bottom line in orange shows. We're back down to about a negative 73% ratio. It got down to about a flat negative 1-to-1 or negative 100% back in early 2025. This, I think, is a level as you get towards the negative 100%, you start to really fight the ability of the cattle to go any higher. So what we've seen this week so far with June now as lead month futures is it's tried to go up to where April ran up right before expiration, made that new all-time high of 217.70. Can the June do that, or are we going to open up ourselves to a technical correction here? And I think that's what this week is going to dictate, or kind of probably tell us and give us some good guidance on. The other thing I will tell a cattle trader out there that has been very active is your April range of monthly trade and fat cattle lead month futures was about $20. Your March range was over $22. Get ready for at least $25 monthly ranges, maybe higher here the next 6 to 8 months. So be ready for what could be an extremely wild ride.
I'll ask you real quick too on feeders. Are you in the camp that $300 mark in August futures, is that going to be resistance, or is that just going to be a psychological point that traders are going to find a way to push through here in the short term?
Yeah, I think it'll be resistance until we would clear something like 303 or 305. That would open the upside back up. I've got some swing objectives on both the August feeders and the June fats as far as upside potential if the momentum wants to stay on our side. Funds want to keep building back up to a record net long, Jesse. But I'll look at that again at the end of this week because we did do a little chart damage on the June fats by taking out the weekly lows. Close back up above them and close back up above a trend line support. But we're testing the resolve of the bull right now in the fat cattle market. The other thing I'll throw out is I do not sell LRP, so I don't know a lot about it, but I do know enough about it that if you're looking at covering the downside with either puts or LRP, this may be a situation with these record high prices that the puts may be a better type of scenario to utilize because if the market keeps running higher, you can move those puts up and improve your floor price, especially as we get to these more common June and August marketing time periods. So take a look at that. Give me a call if you have any specific questions.
Well, Mike, if folks want to reach out to you there at Global Commodity Analytics, I know a couple ways to do so. How can they reach you?
globalcomresearch.com with 2 M's, globalcomresearch.com, or give me a call at 866-471-2588. You can find that phone number on the website as well.
Mike Zuzolo, Global Commodity Analytics. Always a pleasure. Thanks for joining us. Have a great week. We'll talk to you next week.
I appreciate you having me, Jesse. You have a great week too, sir.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.